Treasury yields can be used as important barometers of where the market is and where investor sentiment may be headed. But what exactly are they, and why should you pay attention to them? On this IBD Explains, we ask, what are Treasury yields and why are they important for investors? Here with me to break things down is IBD's personal finance and management editor, Matt Krantz. So Matt, for those that have been following stocks in recent months, it seems like we've been hearing a lot about Treasury yields. So what are they?
Simply stated, the Treasury yield is the price that the government has to pay you in order to get you to lend them money. And the higher it is, the more dear they have to pay. I like to think of it as kind of like a trust meter. Basically, the more you trust someone, the less they have to pay you. So if a neighbor comes by, a neighbor's kid, and wants to borrow money to start a lemonade stand, probably not a lot of trust there. Your interest rate's going to be really high. But if Uncle Sam comes over and wants to borrow money, it's usually lower. With that said, even Uncle Sam is going to have to pay up more because people trust the government and long-term bonds less and less. And that's what's kind of unnerving the markets.
And why do we key in on the 10-year Treasury yield?
That's a great question. It's changed. It used to be the 30-year that everyone paid attention to, but there just wasn't as much trading activity. It's really based on how liquid the market is, and the 10-year Treasury is kind of the benchmark. That's where a lot of the trading activity is. That's kind of where the government's borrowing a lot of its paper at. So it's just a very active contract, I guess you could call it.
What factors affect Treasury yields, and what do their fluctuations mean for stocks?
That's what's so cool about the Treasury yield, and it's so fascinating. And you can look at it in so many ways. It's like a painting. I mean, every time you look at it, you see something different. It's kind of a measure of trust, for one. So when the government is threatening to shut down or doing crazy stuff like that, people want to get more return, so the rate on the 10-year will rise. If they're worried about the future, the rate on the Treasury may rise. If they're worried about stocks and they don't want to buy stocks or they want less risk, Treasury yield will sink because more people will sell stocks and buy treasuries. So it's kind of like a gauge of expectations about the future and fear. And there's a lot kind of wrapped up in there. And it's a lot of fun to kind of try to tear it apart.
You know, we've been hearing a lot about interest rates lately. And what's the relationship then between Treasury yields and actions taken by the Fed?
Yes. So the Fed can't control long-term rates. So the Fed can't directly, I should say, cannot directly influence the 10-year Treasury. It is more on the short-term end of things. So it can jack up, short-term rates that it charges the banks. But that, of course, ripples out. And so when the Fed is raising rates like it has 11 times to short-term rates, it pushes the long bond up too. But the thing that's kind of fun is it doesn't have to rise at the same pace as the short-term bond. So the Fed can control short-term rates very directly, but the rest of it's up to the market. And that's where all the fun interpretation comes into play.
So are Treasury notes good investments, and what's the best way to invest?
They can be, and I'm going to say can because in the last 5 years, they've been a disaster. The crash, and let's call it a crash, in the 10-year Treasury is akin to the dot-com bust. I mean, people that bought the 10-year Treasury lost about half their money on a price percentage basis. And so that is just brutal. And that stings doubly much because people usually buy Treasuries because they want to play it safe. With that said, they do tend to be an okay investment long term, sometimes, most of the time, if you hang on to them forever. There's a lot of different ways to buy them. A lot of people would like to buy them directly from the government. The government has a website that you can go to and you can purchase them straight from them. It's great because you don't pay any fees whatsoever, but you have to keep track of it all yourself. You have to do all your laddering yourself, which is kind of adjusting for risk of different durations of bonds. And that's not a joyride. So a lot of people will just buy it through an ETF or a mutual fund instead. The most popular by far is the AGG. It's an ETF that tracks the aggregate bond market. The thing to keep in mind is only about half of that or so is in treasuries, long-term treasuries. There's corporates mixed in there and other types of securities to give it a aspect of the whole bond market. But it's neat because with one trade, just AGG in your brokerage account, you can get a nice mix of bonds.
So you've told us how to buy, but is there an ideal time to be buying treasuries?
That's a tricky thing because anyone that tries to predict what the Fed's going to do is usually wrong. And people that predict long-term interest rates are usually wrong too. John Bogle of Vanguard gave good advice that's always stuck with me on that. He says, look at what the yields are right now. Are you okay with that yield right now? for 10 years, buy it now. If it's not adequate for you, don't buy it. So for a lot of people right now, a 10-year Treasury at 5% is pretty good. It's going to beat inflation and it's decent. It's okay for like a long-term portfolio. If that's the case, you could probably feel okay about buying it now. But if you back up just a couple of years ago when they were basically zero, that wasn't okay for really anybody. I mean, with inflation at 3% and getting what 0.5% on a 10-year Treasury, I mean, that makes sense for no one, but people still bought it. But that's, I think, a case of Bogle's guide of just looking at it now and just determine if that return is adequate for what you want.
Well, Matt, thank you so much for your insights and guidance as always.
Thanks so much.